Welcome to the D-Risk Weekly Global Markets Brief. It is Sunday, December 28th, 2025. Last week, we tracked the deflationary melt-up, where bad news for the economy became good news for stocks. But as we close out the year, the narrative has sharpened into something far more specific and potentially more dangerous. The theme of the week is the Fiat Fracture. While trading volumes have thinned for the holidays, a massive signal is flashing in the currency and commodity markets. We are witnessing a historic divergence. The US dollar has officially broken down technically, while gold has surged to all-time highs, decoupling completely from traditional rate logic. Investors are no longer just buying growth. They are aggressively buying protection against currency debasement. It is a quiet week for equities, but a loud week for the plumbing of the global financial system. The question we need to answer today is, are we seeing a temporary holiday drift or the beginning of a structural regime change for the dollar? Alex, let's start with the international picture, Asia and Europe.
Thanks, Sarah. The international data confirms that while the US dollar weakens, global equities are finding a bid, driven by that same liquidity hope. Starting in Asia, the Nikkei 225 drifted higher by 0.28% this week, closing at 50,543. The market is stabilized following the Bank of Japan's rate hike to 0.75%. Despite the tightening cycle, the long-term trend remains robust. As the data shows, the Nikkei retains a golden cross, with the 50-day at 50,087 sitting comfortably above the 200-day at 42,373. The price is holding above both levels, suggesting the bull market is absorbing the rate shock. In China, the Hang Seng Index rallied 1.58% to close at 25,902. The narrative here is a tug-of-war between optimistic state media reports of a strong and steady economy and the reality of youth unemployment. Technically, the Hang Seng is in a golden cross configuration, with the 50-day at 25,962 leading the 200-day at 24,705. However, note that the closing price of 25,902 is fractionally below that 50-day line, implying some short-term overhead resistance despite the weekly gain. Moving to Europe, the mood was cautiously optimistic. The UK's FTSE 100 ticked up 0.99% to close at 9,871. The catalyst remains the Bank of England's recent cut to 3.75%, which is feeding through to lower mortgage rates. The technicals are pristine. We have a golden cross with the 50-day at 9,681 widening above the 200-day at 9,084, and price action is firmly confirming the trend. Finally, Germany's DAX rallied 1.09% to finish at 24,340. Even though the ECB held rates steady, the Bundesbank's forecast for a recovery in 2026 gave investors a reason to buy. The DAX also confirms a golden cross, with the 50-day at 23,950 above the 200-day at 23,613. Sarah, across the board, international markets are ending 2025 with technical momentum intact.
It is a sea of green overseas, Alex. The technicals in Europe and Asia suggest that investors are looking past the immediate economic friction and positioning for a recovery year in 2026. But this brings us to the anomaly. If global equities are stable and central banks are diverging, why is the world's reserve currency buckling? Is the U.S. market following the global rally, or is the dollar's weakness flashing a warning signal for U.S. assets?
The U.S. is decoupling, Sarah, but in a way that suggests capital is fleeing paper money for hard assets. This is where the fiat fracture becomes undeniable. Let's look at U.S. equities. Activity was muted due to the holiday. S&P 500 futures were effectively flat, drifting down a marginal 0.03% to trade around 6,977, while Nasdaq 100 futures were similarly quiet, down 0.05% to 25,851. The market is in a holding pattern, waiting for the calendar to flip. However, the real story is the U.S. dollar index, DXY. It slid 0.61% this week to close at 98.00. This move has triggered a major technical breakdown. As the data implies, the DXY has confirmed a death cross, where the 50-day moving average at 99.00 has crossed below the 200-day moving average also at 99.00. With the price now at 98.00, below both averages, the long-term momentum has shifted to bearish. The market is pricing in aggressive Fed cuts in 2026, and the dollar is paying the price. This weakness in the dollar ignited the commodities complex, specifically gold. The metal surged 4.13% this week to close at a staggering $4,542. This is a breakout of historic proportions. Technically, gold is in a powerful golden cross, with the 50-day at 4,175 trading well above the 200-day at 3,594. When you see the dollar in a death cross and gold in a golden cross simultaneously, it signals a flight from fiat currency. Crude oil, meanwhile, rallied 1.20% to close at 57.00. But do not mistake this for a recovery. The structural damage remains. Oil is locked in a death cross, with the 50-day moving average at 59.00, trading below the 200-day at 63.00. The price of 57.00 is still rejected by that 50-day ceiling. This tells us the rally is technical, not fundamental. In the plumbing, the 10-year Treasury yield consolidated, closing at 4.14%. It has stopped falling for the moment, finding equilibrium as traders assess the inflation outlook. Finally, the volatility index, VIX, remains crushed. It closed at 13.60, signaling that despite the dollar's breakdown, equity investors are complacent. Sarah, the signal is clear. The market is selling dollars to buy gold, while stocks drift on the fumes of liquidity.
Thanks, Alex. That divergence between gold and the dollar is the defining chart of late 2025. A 4% surge in gold against a breaking dollar suggests that the smart money is front-running a year of currency debasement, regardless of what the stock market does. Looking ahead, we are entering the first trading week of 2026. Volumes will return, and with them, volatility. The key catalyst to watch will be the release of the FOMC minutes. Investors will scour the text for confirmation of the rate cuts that the dollar is already pricing in. If the Fed sounds less dovish than expected, that DXY death cross could see a violent reversal. We also have geopolitical risks lingering, with U.S.-China trade tensions and the Russia-Ukraine situation continuing to drive that bid for gold. Watch the 98.00 level on the dollar index. If that support gives way, the Fiat Fracture could accelerate into a broader currency crisis. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.